You know what keeps me up at night? It's not the headlines. It's not the talking heads on CNBC telling you everything's fine. It's the data that nobody's supposed to see. The numbers that got leaked last week from inside the mining industry. And I'm going to show you exactly why this changes everything. Because while everyone's been watching gold hit new records, something's been happening in the silver market that's so severe, so unprecedented, that when this finally breaks into mainstream consciousness, the price movement is going to be violent. I'm talking about a supply deficit so extreme that it makes the nickel squeeze of 2022 look like a warm-up act. Let me paint you a picture of what's really happening right now. 3 days ago, a confidential report from the Silver Institute got leaked to a small group of institutional traders. I got my hands on it. And the numbers are staggering. We're not talking about a minor supply shortage. We're talking about a structural deficit that's been building for 3 consecutive years, and it's accelerating. Here's what the report shows. Global silver demand in 2024 hit 1.2 billion ounces. That's billion with a B. Industrial demand alone consumed 690 million ounces. Solar panels ate up 185 million ounces. Electric vehicles took another 90 million. And here's the kicker. Total mine production? 830 million ounces. Do the math. That's a deficit of 370 million ounces in a single year. But it gets worse. Much worse. Because that deficit number assumes that recycling can make up some of the gap. The report projects 180 million ounces from recycling. Sounds good, right? Except there's a problem. The recycling infrastructure can't scale fast enough. We're already running at maximum capacity. There's no magical supply of silver sitting in warehouses waiting to be melted down. Now, you might be thinking, okay, so there's a deficit. Markets adjust. Prices go up. Miners produce more. Problem solved. And that's exactly what the mainstream analysts are saying. But they're missing something critical. Something that this leaked data makes crystal clear. Silver mines don't just appear overnight. The average time from discovery to production for a new silver mine is 12 to 15 years. 12 to 15 years. And here's what nobody's talking about. There hasn't been a major new silver discovery since 2012. Not one. The pipeline is empty. Let me tell you about what happened in Peru last month. Cerro de Pasco, one of the world's largest silver-producing regions, had to shut down 3 major operations due to water contamination issues. These weren't temporary shutdowns. The Peruvian government issued permanent closure orders. That's 45 million ounces of annual production gone, just like that, wiped off the supply chart, and Peru isn't alone. In Mexico, which produces more silver than any other country on Earth, the government just passed new mining regulations that are so restrictive. Analysts are projecting a 15% reduction in output over the next 2 years. That's another 120 million ounces disappearing from global supply. But here's where it gets really interesting. The leaked report contains something I've never seen published before. Actual inventory data from the COMEX and LBMA vaults. And the numbers are shocking. Registered silver at COMEX, the silver that's actually available for delivery, has dropped to 47 million ounces. That's the lowest level since 1998. Think about that for a second. We have 47 million ounces of deliverable silver backing a market where the open interest represents claims on over 900 million ounces. That's a ratio of 19 to 1. For every physical ounce in the vault, there are 19 paper claims. What happens when people start asking for delivery? We've seen this movie before. Let me take you back to March 2008. Bear Stearns was about to collapse, and nobody knew it yet except the people inside. But there was a signal, a canary in the coal mine. Silver started acting weird. The spread between paper silver and physical silver, the premium you pay for actual metal versus a futures contract, started widening. It went from 50 cents to $2.50 in 3 weeks. Why? Because the smart money knew something was broken. They were getting out of paper and into physical. And when Bear Stearns finally went down, that spread exploded to $6. People who had paper contracts couldn't get delivery. The system seized up. We're seeing the exact same pattern right now. The premium on physical silver eagles from the U.S. Mint is running at $4.50 over spot. That's not normal. The historical average is 80 cents. In Europe, it's even worse. Dealers in Germany are charging €6 premiums on 1-ounce coins. And delivery times? 6 to 8 weeks. For a commodity that's supposedly in oversupply according to the mainstream narrative. Here's what the leaked data reveals about industrial demand, and this is where it gets truly explosive. The solar industry alone is projected to consume 250 million ounces by 2026. That's up from 185 million today. Why? Because every major economy on Earth has committed to massive solar buildouts. China just announced a plan to install 500 gigawatts of new solar capacity by 2028. Each gigawatt requires approximately 400,000 ounces of silver. Do the math. That's 200 million ounces just for China's solar program. And that's on top of existing demand. Where's that silver going to come from? Electric vehicles are the other monster-eating silver supply. Each EV uses about 30 ounces of silver. Sounds small, right? Except global EV production is projected to hit 30 million units by 2027. That's 900 million ounces of annual demand just from cars. And unlike solar panels, which might last 25 years, cars get recycled much slower. That silver is locked up for a decade or more. Now, let me show you something that's not in any official report, but it's happening right now in the physical market. There's a group of family offices, ultra-wealthy individuals managing their own money, who've been quietly accumulating physical silver for the past 18 months. I'm talking about serious size. One family office in Singapore took delivery of 15 million ounces last year. Another in Switzerland has been buying 2 million ounces a month since January 2024. Why? Because they've done the math. They understand that silver is the most undervalued hard asset on the planet. The gold-to-silver ratio is currently sitting at 88 to 1. Historically, it averages 60 to 1. During times of monetary stress, it's collapsed to 30 to 1 or lower. In 2011, it briefly touched 32 to 1. If you're sitting on significant retirement savings, and I'm talking about folks with $100,000 or more in IRAs or 401ks, this is something you need to understand, because there's a way to get physical precious metals into your retirement account without triggering taxes or penalties. I put together a free guide that breaks down exactly how gold IRAs work, what the rules are, and how to evaluate if it makes sense for your situation. It's in the description below. No sales pitch, just the mechanics and what you need to know. Worth checking out if you're thinking about portfolio protection. But back to what's happening in the supply chain, because this is where the leaked data gets really disturbing. The report contains internal communications from 3 major mining companies, and what they're saying privately is completely different from what they're telling investors publicly. Publicly, these companies are talking about increasing production, optimizing operations, hitting targets. But internally, they're panicking. One memo from a senior executive at a top 5 silver producer literally says, "We cannot meet contracted delivery obligations for the third quarter of 2025 without purchasing metal on the open market." Read that again. A major silver mining company is going to have to buy silver to fulfill its delivery contracts. That's like Saudi Arabia buying oil to meet export commitments. It doesn't happen unless something is fundamentally broken. And it's not just one company. The leaked data shows that industry-wide, miners are running into a wall called declining ore grades. Basically, the easy silver is gone. What's left requires processing twice as much rock to get the same amount of metal. That means higher costs, more energy, more time. And it means that even if silver prices double, production can't scale quickly. Here's a specific example. The Cannington mine in Australia, one of the world's largest silver producers, has seen ore grades decline from 400 grams per ton in 2008 to 180 grams per ton today. They're processing more material than ever, but getting less silver. And this pattern is repeating at mines across the globe. Now let's talk about what's happening in China, because this is the part that should terrify anyone paying attention. China is the world's largest silver consumer. They use it for everything: solar panels, electronics, 5G infrastructure, electric vehicles, and for years they've been a net importer, bringing in about 150 million ounces annually. But something changed in late 2024. Chinese imports of silver suddenly dropped by 40%. Did their demand collapse? No. Industrial consumption is at all-time highs. So where's the silver coming from? The leaked report has the answer, and it's chilling. China has been drawing down strategic reserves. The Chinese government maintains strategic stockpiles of critical materials. Nobody knows exactly how much silver they have, but estimates range from 500 million to 1 billion ounces. And they've been quietly selling into their domestic market to keep prices stable and supply flowing to manufacturers. Why does this matter? Because those reserves aren't infinite. And when they run low, China is going to come back to the international market as a buyer. And when they do, with their massive demand, the impact on global prices is going to be seismic. Let me give you a historical parallel. In 2010, China was a net exporter of rare earth elements. They had huge reserves. They were selling to the world. Prices were stable. Then in 2011, They decided to restrict exports to prioritize domestic use. Rare earth prices went up 10 times in 6 months. 10 times. And that was for materials with far less industrial importance than silver. What happens when China comes back as a buyer? In a market that's already running a 370 million ounce annual deficit. What happens when they need to import 150 million ounces again? But global production is declining, and industrial demand from the rest of the world is increasing? The leaked data projects that by 2027, the annual supply deficit could reach 550 million ounces. That's more than half of total global mine production. There is no historical precedent for a deficit of that magnitude in any major commodity market. None. And here's the thing that keeps me up at night. The silver market is tiny. The total value of all the silver mined in a year is about $25 billion. That's less than the market cap of Netflix. It's a rounding error for major institutional investors. But it's critical to the entire green energy transition, to electronics, to 5G, to electric vehicles. What happens when pension funds, sovereign wealth funds, and central banks realize that silver is both critically scarce and absurdly cheap? What happens when they start allocating even 1% of their portfolios to physical silver? Let me walk you through the math. Global pension fund assets are about $50 trillion. If just 1% of that flows into silver, that's $500 billion of buying pressure hitting a $25 billion annual market. It would be like trying to pour Lake Superior through a garden hose. And there are signs this is already starting. The leaked report mentions that 2 sovereign wealth funds have been in discussions with major miners about long-term supply agreements. They want guaranteed delivery of physical metal, locked in at today's prices, for the next decade. The miners are hesitant because they know they can't guarantee supply. Now let's talk about what happened in 1980, because there are eerie parallels to today. In 1979, silver was trading around $6 an ounce. The Hunt brothers, a wealthy Texas family, started accumulating physical silver. They understood that industrial demand was growing, supply was tight, and the metal was undervalued. By January 1980, silver hit $50 an ounce. It went up 8 times in a year. And that was in a market with far less industrial demand than today. There were no solar panels, no electric vehicles, no 5G networks. The industrial use case for silver was a fraction of what it is now. But here's what's different today. In 1980, the price spike was driven by speculation and a corner attempt. It wasn't sustainable because the fundamental demand wasn't there. When the Hunt brothers were forced to liquidate, prices crashed. Today, the demand is real. It's structural. It's not going away. Solar installations are accelerating. EV production is ramping up. 5G infrastructure is expanding globally. This isn't speculation. This is the entire global economy transitioning to technologies that require massive amounts of silver. And unlike 1980, there's no cavalry coming. There are no major new mines about to come online. There's no surge in recycling capacity. There's no strategic stockpile that governments are willing to release. The supply side is tapped out. Let me tell you about what's happening in the futures market right now, because this is where you can see the stress building. The COMEX silver contract for March 2025 delivery is trading at a premium to the spot price. That's called backwardation, and it's extremely rare in commodity markets. It means people are willing to pay more for silver today than for a promise of silver in the future. Why? Because they don't trust that the silver will actually be there in the future. They want physical metal in hand now. And when backwardation appears in a commodity market, it's a flashing red warning sign that the market structure is breaking down. We saw this in the oil market in 2008, right before prices spiked to $147 a barrel. We saw it in the natural gas market in 2021 before prices went up 5 times. And we're seeing it now in silver. The leaked data also reveals something about central bank behavior that's not widely known. While everyone focuses on central banks buying gold, and they are at record levels, there's been quiet accumulation of silver as well. The report mentions that 3 central banks in Asia have been purchasing silver through intermediaries to avoid moving the market. Why would central banks buy silver? Because they understand what's coming. They see the supply deficit. They see the industrial demand growth. They see the monetary instability. And they're positioning for a world where hard assets matter more than paper promises. Here's something else from the leaked data that's absolutely critical. The report contains projections for what happens to silver prices under different scenarios. In their base case, which assumes modest demand growth and stable supply, they project silver hitting $45 an ounce by 2026. That's a 70% increase from current levels, but that's the base case. In their bull case, which assumes strong industrial demand growth and continued supply constraints, they project $85 an ounce by 2027. And in their extreme case, which models what happens if there's a supply crisis or a rush to physical metal, they project prices above $150 an ounce. Now, I'm not saying any of these projections will come true. Markets are unpredictable. But what I am saying is that the people inside the industry, the ones with access to real supply data, are modeling scenarios where silver prices triple or quadruple from here. And here's the thing. Even at $150 an ounce, silver would still be below its inflation-adjusted 1980 high. In today's dollars, that $50 peak would be about $180. So we're not even talking about unprecedented territory. We're talking about silver getting back to levels it's hit before, in an environment with far stronger fundamental demand. Let me tell you about what's happening in India right now, because this is a microcosm of the global situation. India is the world's largest consumer of silver for jewelry and silverware. It's cultural. It's traditional. Indian families buy silver for weddings, for festivals, for savings. In 2024, Indian silver imports hit a record 320 million ounces. That's up from 240 million the year before. Why the surge? Because Indian citizens are losing faith in the rupee. Inflation is running hot, the currency is weakening, and people are converting cash into hard assets. And here's what's interesting. The Indian government tried to slow down silver imports by raising tariffs. They went from 10% to 15%. Did it work? No. Imports actually increased. Because when people are trying to preserve wealth, they'll pay the premium. The demand is inelastic. Now multiply that dynamic across the developing world. Turkey, Argentina, Egypt, Pakistan, countries with currency instability and inflation problems. They're all seeing surges in precious metals demand. And unlike gold, which is expensive and out of reach for many people, silver is accessible. You can buy an ounce of silver for $30. It's the people's money. The leaked report projects that investment demand for silver, people buying coins, bars, and ETFs, could double by 2026. That would add another 200 million ounces of annual demand to a market that's already running a massive deficit. Here's where the math becomes impossible. Let's add it up. Industrial demand growing by 100 million ounces. Investment demand growing by 200 million ounces. That's 300 million ounces of new demand on top of the existing 370 million ounce deficit. We're talking about a 670 million ounce gap between supply and demand. There is no scenario where that gap gets filled by increased mining production. It's physically impossible. The mines aren't there. The ore grades are declining. The permitting process takes years. The capital isn't flowing into new projects because investors got burned in the last commodity cycle. So what gives? Something has to give. Either prices go up dramatically to destroy demand, which means industrial users have to cut back, which means slower economic growth, or we see supply disruptions, shortages, and rationing. And here's the geopolitical angle that nobody's talking about. Silver is critical for military applications. Missiles, radar systems, electronics, batteries, they all use silver. The U.S. military is the largest single consumer of silver in North America. And right now, with tensions rising globally, with the possibility of conflict in multiple theaters, military demand for silver is increasing. What happens if there's a major conflict and governments start commandeering silver supply for military production? What happens to the civilian market? What happens to prices? The leaked data mentions that the Pentagon has been in discussions with domestic miners about securing long-term supply agreements. They're worried about dependence on foreign sources. They're worried about supply disruptions. And when the military starts worrying about commodity supply, you know the situation is serious. Let me take you back to 2011 for a moment, because there are lessons there. Silver went from $18 in August 2010 to $49 in April 2011. It nearly tripled in 8 months. What drove that move? A combination of factors. QE2 was flooding the system with liquidity. The dollar was weakening, and there was a supply squeeze as industrial demand recovered from the 2008 crash. But here's what's different now. In 2011, the supply deficit was about 50 million ounces. Today, it's 370 million ounces and growing. In 2011, solar demand was negligible. Today, it's massive and accelerating. In 2011, there were no electric vehicles. Today, EV production is exploding. The fundamental case for silver is stronger now than it's ever been in history. And yet, the price is lower in real terms than it was in 2011. That disconnect can't last. Markets eventually reflect reality. And when this market corrects, when price catches up to fundamentals, the move is going to be violent. Here's what I'm watching for. The first sign will be delivery failures at COMEX. Someone's going to stand for delivery, and the exchange won't be able to provide the metal. They'll offer cash settlement instead. And when that happens, confidence in the paper market will evaporate. The second sign will be premiums on physical metal going parabolic. We're already seeing elevated premiums, but I'm talking about $10, $15, $20 over spot. When you can't get physical metal at any reasonable price, that's when you know the system is breaking. The third sign will be mining companies suspending forward sales. Right now, many miners sell future production at fixed prices to lock in revenue. But if they believe prices are going much higher, they'll stop doing that. They'll want to capture the upside. And when miners stop selling forward, it removes a major source of supply from the market. All three of these signs are starting to appear. We're in the early stages of what could be the biggest supply crisis in commodity market history, and most people have no idea it's happening because they're watching the paper price, which is being held down by futures market manipulation and central bank intervention. But you can't manipulate physical reality. You can't print silver. You can't create it out of thin air. And when the physical market overwhelms the paper market, when people demand delivery and there's nothing to deliver, the price discovery is going to be brutal. Here's my final thought. We're living through the greatest monetary experiment in human history. Central banks have printed trillions of dollars, euros, yen, yuan. They've suppressed interest rates to zero or negative. They've inflated asset bubbles across every market. And now, they're trapped. They can't raise rates without crashing the economy. They can't keep printing without destroying currencies. In that environment, hard assets matter. Things you can hold, that can't be printed, that have real industrial use. Silver checks every box. It's money. It's a commodity. It's critical for technology. And it's scarce. The leaked data I've shown you today is just confirmation of what anyone paying attention already knows. The silver market is broken. Supply can't meet demand. The deficit is growing, and the price is going to have to adjust to reality. The question isn't if, it's when. And based on what I'm seeing in the physical market, based on the stress in the futures market, based on the behavior of smart money quietly accumulating, I think when is sooner than most people expect. This isn't financial advice. I'm not telling you to buy anything, but I am telling you to pay attention. Because what's happening in the silver market right now is a preview of what's going to happen across commodity markets as the green energy transition collides with resource scarcity. And the people who understand this early, who position themselves before the crowd figures it out, are going to be the ones who preserve and grow wealth in the chaos ahead. The data is out there. The evidence is mounting. The supply shock is real, and it's worse than anyone thought.